Most first-time home buyers in Canada are unknowingly walking into tens of thousands of mortgage penalty and higher rates. 6 out of 10 Canadians break their mortgage in between. So don't be one of them and watch this before you sign anything. Buying your first home in Canada is exciting, but getting the mortgage, this part can get complicated and expensive as well. My name is Parth Soni. I'm a real estate agent. I help first-time home buyers to avoid costly mistakes. In this video, you will learn how mortgage really works, what type of terms and penalties, and most importantly, what not to do before you apply. This is the ultimate mortgage guide for all the newcomers to Canada and also for the first-time home buyers. So let's check out first thing, what is mortgage? So a mortgage is a loan from the lender to help you buy a property. In Canada, you typically need a down payment of at least 5% of the purchase price. And the lender gives you rest and you agree to pay them back with an interest, and that is usually between 25 to 30 years depending how you structure it. Now the second thing, most of the time many first time home buyers get confused, is the pre-qualification versus a pre-approval. So let's clear this up. So pre-qualification is just an estimate. It's a basic calculation using your income and debt. It's a quick but mostly useless when making an offer. This is something you can get from 𝗦𝗡𝗏𝗧𝗔𝗍. Usually you just put down some numbers and they will give you how much of a mortgage you can get from a lender. On the other hand, a pre-approval is a formal document from a lender that says based on your document and credit, you are approved for a mortgage up to X amount. Usually it does put down what interest rate you will be getting from that lender. So when you are shopping, do not confuse between pre-approval and a pre-qualification. And sometimes I have seen many mortgage agents don't give you a mortgage pre-approval, they just give you a number verbally. This is something a big red flag, especially if you are someone who's very serious about buying a property. So make sure you have a proper documentation in place before shopping around. Now let's check out what is the difference between a bank and a mortgage broker. So should you go with a bank or a mortgage broker? So banks offer their own rates and their own products, sometimes not best, because let me give you an example. Let's say if you're going with TD Bank, then they will only provide you all the products that are available within the TD Bank. They will not provide you products available for Scotia or RBC or any other bank. And well as on the other hand, mortgage broker shops your application across multiple lenders, banks, credit unions, B lender, and even sometimes a private option if you're opting for that. They work for you and not for the lender. Sometimes I have seen mortgage broker getting a better rate than the bank itself. So make sure you work with a reputed mortgage agent, and in this case, who can provide you a pre-approval letter and also can guide you from A to Z. Said that not all mortgage agents and realtors are equal. Sometimes we have seen so many horror stories that mortgage agents screwing people over for their benefit. So make sure you work with someone you can trust them and have all the information ready for them to deliver. And so many times people think that bank representative or the bank advisors are not that motivated enough to guide you or give you a proper advice. On the other hand, I have seen contrary. Like I do work with a couple of bank representative and they are pretty much that whole, they give you quick response. But again, it depends on person to person who you are dealing with, whether you are dealing with a bank representative or you are dealing with a mortgage agent in person. Now let's check out what are the type of mortgage terms we have. So a mortgage term is how long you're locked into the contract. Usually it's anywhere between 1 to 5 years. In Canada, most people choose a 3 or 5 year term. That is usually a fixed term. But here's the catch. Most Canadians break their mortgage early, and that's where the penalty comes in. A 5-year fixed rate might not be the best if you are someone who plans to sell it soon or refinance it before that. Now let's check out what is the difference between fixed versus variable mortgage. In a fixed rate, same payment for the entire term, great for budgeting. Whereas in a variable rate, it fluctuates with the prime rate. In Canada, we have a prime rate of 4.95%, and typically the customer gets some discount on the prime rate. Usually lower to start with, but risky in a rising rate environment. And this is something what we all have observed back in 2022, 2023. What happened when the mortgage rate goes up? Most of the people like me, including me, who are on variable, their mortgage shoot. Some lenders offer a convertible mortgage where you can switch from variable to fixed in one time, but you cannot switch again you may have an option, but sometimes they charge so much high penalties for that. And when you are looking for a variable one, always ask for the trigger rate if you're considering it. Now, there are so many videos out there to provide you guidance about what to go for, whether go for a fixed or a variable. Now, it depends on the type of person and the type of motive you have with that property. For most of the people, first time home buyers, sometimes if you are planning to hold it for at least 5 years, fixed may make sense provided that you are not that much of a risk adverse person. Now let's talk about mortgage penalties. Now this is where most first time home buyers get hit hard. If you break your mortgage early, which 6 out of 10 Canadians do, you could pay a pre-penalty or prepayment penalty. On a fixed rate, usually it's 3 months of interest or greater. It's usually called an interest rate differential, IRD. In the variable rate, same thing, typically 3 months of interest, but with fixed mortgages from big banks, IRD can cost you up to $10,000 to $30,000 or more. I have a client back in December of 2022 when they want to break their mortgage. Their penalty was roughly about $35,000 or $37,000, so it could go really high. So whenever you are signing this document, ask the lender about this penalty before you sign. Now let's talk about mortgage insurance. Now if your down payment is under 20%, you are legally required to get a mortgage default insurance. This protects the lender, not you, but you pay the fee. It can add thousands of dollars in your loan, and that is rolled into your mortgage balance. If you want to check out what will be your mortgage insurance, you can quickly check out over here. It's 𝗦𝗡𝗏𝗧𝗔𝗍. Now, if you're someone who's considering buying your first home, check out over here what are the process looks like. And if you're someone who's buying your condo, I have made a detailed guide of how to buy a condo in Ontario. Now, let's check what not to do before applying. And here are the bunch of mistakes many people do when they apply and after applying. So the very first one in this one, don't quit your job. Most of the time, lender do want some history from your current employer. The second thing would be don't get a new car or finance a new car, or don't open a new credit account. There are other things that goes without saying, like don't make any large deposit without documentation, don't co-sign any loan, and the very basic would be don't lie on your application, which we have seen many people do that, especially when they want to buy an investment property. Not very much for the first time, but so many people do lie on their application for their first home as well. And this can derail your approval or delay closing. Now there are other costs also you need to consider when you're looking for a home. Now buying a home comes with more than just a mortgage, so there are other costs also that you may need to consider. The very first one in this one are the legal fees that can go anywhere between $1,500 to $2,500 depending on the lawyer you go for. The next one on the list would be a home inspection, typically between $400 to $600. Next on the list, if you're buying in Ontario, would be a land transfer tax. You can go on realtor.ca or 𝗦𝗡𝗏𝗧𝗔𝗟 to check out particularly what will be a land transfer tax if you're a first-time home buyer or not a first-time home buyer for that property. Then the title, insurance, moving costs, property taxes, utilities, so many more. So usually what we advise client is to take about 1.5% to 3% of your purchase price as a closing cost. Now let's talk about choosing the right lender. Not all lenders are equal. Some will have a lower rates but higher penalty. Others might offer cashback, flexible terms, or portability if you move. So always ask, what are my penalties in this one? Can I port this mortgage if I am planning to buy a new home in near future? Is this a collateral charge or a standard charge mortgage? So this kind of questions you should be asking to your mortgage agent or bank when you are applying for the loan. Now mortgages don't have to be scary, but they do need your attention. Here is your mortgage summary. Very first one on the list is get a pre-approved, not just pre-qualified. The second one would be understand your terms and penalties. Third would be work with a mortgage broker or a bank and shop around for rates. The fourth would be avoid rookie mistakes during the approval process. And the last one would be plan ahead of all the costs, not just your down payment. Thank you so much for watching. The only thing I ask, if you like this kind of content, do subscribe to my channel. I will see you on the next one.